Asia-Pacific markets are mixed as investors assess Japan's inflation data. Meanwhile, US tariffs are shaking Africa's biggest economies and pushing the continent toward deeper regional trade. And we explore why the world's most educated generation is also the most financially squeezed. Hello, I'm Taiba Aiden with the latest business and finance news here on TRT World. Asia-Pacific markets traded mixed to end the week, with most markets closed for Good Friday. Japan's benchmark Nikkei 225 rose around 1% after the country's inflation grew 3.6% year-on-year in March, marking 3 straight years that the headline inflation figure is above the Bank of Japan's 2% target. South Korea and Japanese shipping stocks rose after US President Donald Trump's administration on Thursday imposed fees on ships built in China. Meanwhile, gold's record rally paused after a sharp rise the previous session as investors booked profits ahead of a long weekend. But a softer dollar and escalating trade tensions between the world's largest economies keeps demand for safe haven assets high. For more, we're joined by Bas Kujerman, CEO and asset manager at DHF Capital SA. He joins us live from Vilnius. Bas, now let's look at the markets first. It's been a short trading week for most and quite a mixed one overall. So what do you make of the recent activity?
Yeah, it's a lot of volatility lately, especially in the gold market, where we are very active, seeing a 3% growth day on Wednesday and over 12% in just 1.5 weeks. A short week indeed. Gold markets closed yesterday 3,325 after a short drop, but in generally the market is in a very strong uptrend on the precious metals, more uncertainty on the US stock market.
Right, and some analysts expect gold to hit as high as $5,000 per ounce. Do you see that happening?
That is a very good question. I think over time, gold is a safe haven asset, so therefore there is an option that it keeps growing as long as there's uncertainty in the markets. Last 2 years, we have seen an extreme rise due to geopolitical tensions. 5,000 is, I think, quite far away. 3,500, for example, or even 4,000 towards the end of the year, if nothing economically changes, is definitely possible.
Right, and how are Trump's tariffs increasing the demand for safe haven assets?
I think that funds always move from one asset class to the other asset class, depending on if there are tensions or things changing in the economical environment. So in this case, we have seen a large drop of US equity markets, and those funds have been moving to safer assets, where one of them is gold. We've seen a nice trend upwards for silver as well, and an upcoming silver industry where basically we see silver is being used for electric cars, for solar panels, and is heavily undervalued, 80 to 1 instead of 25 to 1 on gold in 2024. So safe haven assets and this kind of useful metals are definitely in a good position at this moment.
And what about cryptocurrencies amid all of the trade tensions? How is the demand for that looking?
So we see actually Bitcoin being quite stable since the beginning of March. Of course, it's a volatile asset with a lot of activity, but price-wise, it is around all those support levels where we see the value stagnate. Ethereum still in a serious downtrend, unless proven differently from technical perspective. We see that those are currently not held as safe haven assets. We saw a rise together with gold early April, March last year when all the ETFs came online. So basically people were trying to both invest in the cryptocurrency space as well in gold for a healthy hedge. But at this moment, they are disconnected from pricing.
Right, Bas Kujuman, CEO and asset manager at DHF Capital. Thank you very much for your insights.
Thank you for having me.
The US is now talking with its biggest trading partner and adversary in Donald Trump's tariff war. President Trump says the discussions with China are about negotiating a way out of the soaring tariffs imposed by both sides. Andy Rosejan has the latest.
Talking to us, it is incredible.
It was confirmation that apparently the U.S. and China have reached the mountaintop of their tariff war and are ready to start talking down the ledge.
I think that we will make a deal with China. I think we've had some very good talks, but we will have some very good talks remaining. I would think over the next 3 or 4 weeks, I think maybe the whole thing could be concluded.
Trump praised Chinese President Xi again after their tariff war reached astronomical levels last Friday. The U.S. imposed 145% tariffs on incoming Chinese goods, and China imposed 125% tariffs on incoming U.S. goods. But Trump was coy about anything that was discussed. The White House says there are about 15 nations that have begun tariff negotiations with the U.S. Japan was in town this week, and South Korea apparently set to arrive next week. Trump says he's in no rush to reach tariff deals. But many American small businesses who sell almost all Chinese-made goods and who have to decide how much more they are willing to charge their customers to pay for the tariffs say there is a rush.
There is only a certain amount someone can spend. So as much as my customers would want to support me, I don't think I can charge $75 for a 50-gram bag of tea, no matter how amazing that tea is.
Critics say Trump's desire to use tariffs as a way to bring manufacturing jobs and supply chains back to the U.S. is unrealistic.
We can't grow tea in the U.S. to the extent that we need. We can't just flip the industry and make tea great again in America.
American stocks continue to gyrate wildly on tariff news, down again on Thursday over 500 points after the Federal Reserve chairman warned the tariffs will bring inflation. But Trump insisted that the U.S. is like a big, beautiful department store. Everybody wants a piece, he said, but they have to negotiate to get in. Andy Rosejan, TRT World, Washington.
African nations are hugely reliant on external trade, with more than 80% of exports headed outside the continent. But some analysts say the tariffs introduced by US President Donald Trump could present a new opportunity to pursue deeper regional integration. Emre Boz has more.
South Africa could see its industrial production slow, despite the fact it's only facing a 10% tariff from Donald Trump. It's the largest economy on the continent, but analysts say that any additional duty will affect multiple sectors like manufacturing, energy and agriculture. This may mean falling employment and reduced investments.
It's not only South Africa that is affected. You've seen everyone is being subjected to this kind of a situation. But we as South Africa, you know, we've been participating in the AGOA, which is the Africa Growth Initiative, wherein we were looking at markets in the U.S. to export either our agricultural produce or any other products that we produce in South Africa. So with these tariffs, it's going to be very difficult for our businesses to continue.
The impact of the tariffs is continental. The US is a huge market for African products, with exports valued at more than $71 billion in 2024. In Lesotho, the textile industry accounts for 90% of manufacturing exports. Tariffs may raise prices for US buyers, likely reducing demand. And for countries like Nigeria, non-oil exports like agricultural goods to the US facing any price hikes may mean reduced competitiveness for these businesses, which is made worse by uncertainty over the African Growth and Opportunity Act in the US. The trade pact gives duty-free US market access to 35 African countries, with the 25-year agreement set to end in September. So how are African nations responding? One way is by accelerating efforts to strengthen regional economic cooperation.
If it comes to a push where we continue to not find each other at a diplomatic level with the US, we'll have to opt for your Africa Free Continental free trade area and see how best we can redirect all those products.
It does compel us to move much faster, to accelerate the implementation of the AFCFTA, and to accelerate building a domestic market on our continent.
By replacing the US demand with intra-African trade, the region could soften the blow of slowing growth and rising unemployment. And over time, analysts say deeper integration will help drive higher GDP growth across the continent. But for now, tariffs are impacting not just African economies, but global supply chains as well. Emre Boz, TRT World.
Joining us now from Lagos is Mukhtar Mohammed, international finance and economic analyst. Now, Mukhtar, why are reduced US tariffs still causing concern in some of Africa's key industries?
I think why US tariff is causing concern in some African countries, especially like Nigeria or South Africa, one of the two largest economies in Africa. If you look at the Nigeria own context, I think that is happening because of that has brought down the price of crude, and crude is a major foreign exchange earners of Nigeria. So when you bring those tariffs have brought down the price of crude, and even Nigerian oil benchmark in terms of their budget benchmark for oil is about $75, and today now crude is selling below that amount. So definitely that is what has brought concern for Nigeria. For South Africa, I think it has to do with the aid and HIV/AIDS support that they normally get from South Africa, from the United States of America. Those are what are driving African countries concerned about the tariff that was imposed on them.
And how significant is the African Growth and Opportunity Act to Africa's export and job markets?
Well, I have my little bit of concern about that agreement, because if you look at that agreement that has been signed over 25 years ago, you've not seen so much that has happened between African countries and the United States in terms of export. What we see Africa export to the United States is finished crude oil. Raw material, crude oil, raw material. That's what we basically send to the United States, and they in turn put it into finished product and send it back to us. So it has not been a symbiotic type of relationship. It has been a parasitic type of relationship. You can say that Africa sent a little bit of crops outside to the United States, but those crops, in terms of volume and value that they add to the economy of Africa, in terms of GDP, also is very, very low. So most things that we deal with the United States by this agreement was to make Africa a hub, whereby Africa will be able to bring finished product to the United States of America. But that has not happened in that continental AGOA agreement. So for me, I don't think the agreement have done Africa any good in any sense.
Right, and what would the end of this agreement mean for the future of US-Africa relations?
Well, I don't think it will have so much impact. Like I said, we've not done so much with them. So what I expect Africa to begin to look at is just like what they said in your report, is to see how we can do business within ourselves. And that is going to be a very tough task to accomplish because of infrastructural challenges, tariff issues, security issues, especially through the Sahara region. So Africa have not been able to do trade within themselves so much. Rather, they've been able to do more trade with the Chinese, with the Americans, with the Europeans. I think what this would do is maybe bringing Africans together to see how we can begin to do more trade within ourselves. They're relying in the United States of America for most of our trading. But again, there's a major challenge, like I said, infrastructure and the volume of business that is done within Africans are still very, very low. So about what we've seen in African leaders, instead of looking at how to improve this volume of trade by building infrastructures, what we've seen is to say, we want a single currency. But single currency as it is cannot help African economy because we're not doing so much business within ourselves. So it should not have so much impact, like I said, if Africans are able to come together and begin to also do businesses within themselves and also look for new trading partners, especially when it concerns goods that the United States was their main destination.
And in the immediate term, how can African nations increase their inter-regional trade?
I think, like I said, we have the African Continental Trade Agreement is there. Again, there's challenges with there in terms of cost of production, in terms of tariff, because this agreement is saying if a particular good is produced in your country, then you don't have to pay tariff for it, and it doesn't have to be extravagant tax. But like I said, most of what Africa have is raw materials. And so the industry to make them into a finished product is very challenging. And so that is the major challenge that in the short term that Africa will face. And in the short term, again, Africa will necessarily face revenue shortage. Like I said, in the case of Nigeria, oil price benchmark at $75 per barrel, and today is selling is way, way above that. So definitely they will have a challenge in terms of any more effects into the economy. And once FX is not coming, that affects the stability of their currency. And then the devaluation issue comes in and they have a snowball effect by affecting the industry, then there will be unemployment. So those are the challenges in the short term that Africa will face. But that could be mitigated if we begin to develop that strategy to do more trade within ourselves.
Mukhtar Mohammed in Lagos, thank you very much for that analysis.
Thank you for having me.
Now, Africa's largest gold producer, Ghana, is reforming its local industry and stopping foreigners from buying, selling and exporting gold directly. The government claims it's a new strategy to protect small-scale miners and ensure the sector produces greater benefits for the nation. Isaac Kaleji reports from Accra.
Mining is crucial to Ghana's economy. For decades, it has been a major contributor to its GDP, raking in foreign exchange earnings. Licensed small-scale mining is an important part of this puzzle. Artisanal mining employs at least 1.5 million people directly and indirectly, according to Ghana's Minerals Commission statistics. Over 3,000 small-scale mining groups are registered and licensed to operate. Small-scale miners account for approximately 35% of all gold produced in the country. But the miners accuse licensed gold traders, largely foreigners, of unfair dealings.
The foreigners were taking undue advantage of the sector. Sometimes they buy it as cheap as 20% of the world market price.
The government says it wants to protect the interests of small-scale miners. A new agency, the Ghana Gold Board, would now take charge of all local gold trading activities.
So what is going to happen now is that if you want to sell gold, if you want to export gold, you would have to deal with Gold Board.
In 2022, 60 tons of gold worth an estimated $1.2 billion was smuggled from Ghana, according to the government. Foreign gold traders are sometimes accused of complicity.
The Gold Board concept puts the Ghanaian first, and it's a concept that has been instituted to help us ensure that we maximize profit from our gold and other natural resources.
Local miners have high expectations for the directive.
So if the pricing is coming from the world market price and from what government is buying, I don't think it will be a rip-off like before.
In this day and age of international agreements, bordering on free trade and all that, you'll be opening yourself up for international litigation when it comes to such a regulation.
That means it will be a delicate balancing act for the government.
The directive for foreigners to exit the local gold trading market within weeks has received mixed reactions. While the small-scale miners welcome it as a protection against gold smuggling and delivering fair pricing for locals, some analysts worry the directive could lead to trouble from foreign gold traders in the sector. They want the government to tread cautiously.
Ghana's mining sector still has many challenges, including illegal mining activities, which continue to destroy water bodies and forests. It is yet to be seen how ongoing reforms could positively transform the sector. Isaac Kaleji, TRT World, Accra.
Now a quick look at some of the other top business stories from around the world. The Trump administration has eased plans to charge high port fees on China-built ships after strong pushback from the shipping industry. The original proposal called for fees of up to $1.5 million per port call, but ships will now pay less and only a few times per year. The US says the new rules will begin in 6 months. A US judge has ruled that Google held illegal control over online ad markets, marking the company's second major antitrust loss in under a year. The case said Google's role between ad buyers and sellers gave it unfair power. The ruling comes as Google faces pressure from AI rivals and slowing ad revenue. Netflix has reported stronger than expected results for the first quarter of this year, with revenue rising 13% to nearly $11 billion. The boost came from higher subscriptions and ad revenue. The company also raised subscription prices in January and kept its full-year outlook steady. And Apple's smartphone shipments in China dropped by 9% in the first quarter, marking its 7th straight quarter of decline, while market leader Xiaomi saw a 40% jump in shipments. Apple was the only major phone maker to see a fall, with shipments dipping to 9.8 million units. This decline sent Apple market share to drop 13% from 17% the previous quarter. A degree may open doors, but it no longer secures the future. In the US, millennials are the most educated generation, yet the least financially stable and the lowest paid. Almost 40% of millennials, those born between 1981 and 1996, have at least a bachelor's degree. But despite investing heavily in education, they earn far less than baby boomers, those now over 60 did at the same age. Back in 1989, boomers were making about $50,000, while millennials today earn around $40,000. As the wealth gap continues to widen, millennials own just 5% of the US wealth in 2024, compared to 21% for baby boomers. This generational disparity underscores deeper issues. Many millennials entered adulthood with record-high student debt, which delayed them buying a home, getting married, or starting a family. Millennials are often paying higher rent or mortgage rates in cities where job opportunities are concentrated, making it harder to save. The job market is also changing, with more value placed on skills over certificates. But millennials are also changing. They're prioritizing mental health, work-life balance, remote flexibility, and social impact over salaries. For more on this, we're joined by Mark Humphrey-Jenner, Associate Professor of Finance at the UNSW Business School. Welcome back, Mark. Now, why has higher education failed to deliver financial stability for millennials?
Well, firstly, thanks for having me. And there's some issues that higher education confronts, in particular, one of them being that many people end up in degrees or majors that don't have a particularly good return on investment, or the return on investment is quite distant. Furthermore, some people end up being in colleges that are perhaps for-profit and a little bit not good value. And indeed, for many of those people, they're not actually going to make back the cost of the degree. And according to, for example, the Foundation of Research on Equal Opportunity, their ROI calculator says that for the for-profit colleges, only 45% of them actually have a positive ROA. So a lot of people are ending up in degrees and at colleges that simply aren't creating value for them. The other issue as well is that by going to college, it does delay the person's ability to get into the housing market, which, depending on the market they're in, so it could be a location like New York, for example, where prices generally are trending upwards and are not stagnant. Well, in those markets, people will feel like they'll be getting left behind. So it does create some issues. Now, of course, many colleges still are positive ROI, but there's enough of them that aren't, that it certainly does raise a concern.
So what does this low ROI mean for young people entering the workforce today?
Well, let's first look at how we're calculating this ROI, because there's a few different measures. So one of them, for example, by the Third Way, a 2022 measure, that was basically looking at the number of years it takes you to get a payback on the investment. If you never get a payback, then it's negative ROI. Now, according to them, around 99% of colleges had a positive ROI. Now, that sounds very high, and I suspect that it probably is on the very high end, and many people often will not end up experiencing it quite that way. Nevertheless, it is quite solid there. A more perhaps realistic number comes from the Foundation on Research of Equal Opportunities, and they calculate that around 70 to 75% of these college degrees have a positive ROI. Now, the way they do it is they look at what is the amount, the earnings premium you get from having gone to college. They estimate that relative to effectively the cost of going to college, that type of thing. Now, like I've said, they found about 70 to 75% of these college degrees had a positive ROI. And the Bipartisan Research Center, they use a similar type of method, but they're a little bit more generous to colleges there. About 90% of the degrees are leading to a positive ROI. They're, again, using a earnings premium type method. Now, in terms of these, we're seeing quite a lot of variation. In many of these skills-based degrees, so we're talking things like law or medicine, those having really positive ROIs. But if you're going through to master's degrees or degrees that perhaps have less direct applicability, so some arts degrees, for example, particularly master's degrees in that area, it becomes more of a struggle for people to actually make back the cost of college. A lot of it really depends on what the person is studying, how they're studying it, whether they complete it on time, and where they are studying it. But it does create a lot of complications for the graduates when choosing where to study.
Right, Mark, Humphrey, Jenna, we will have to leave it there. Thank you very much for being with us.
Thanks for having me. Great being with you.
Well, that is all your business news for now. Thanks for watching.